Welcome to this explainer. Look, if you're living abroad, you already know your taxes are a massive headache. But today we're acting as an analytical engine to decode something very specific, the extraterritorial taxation framework, and more importantly, exactly how it intersects with the child tax credit for US expats. We're stripping away the surface level fluff. We want to look at the actual mechanisms, the cause and effect relationships, and the implicit assumptions that govern your tax liabilities overseas. Mastering these overlapping systems isn't just helpful, it's literally the foundation of any successful financial strategy for expatriates. Here's our roadmap. 1. The worldwide taxation baseline. 2. Double taxation mitigation. 3. Income exclusion versus tax credits. 4. Child tax credit parameters. And finally, 5. Alternative dependent credits. Starting off with Section 1, the worldwide taxation baseline. Okay, so at its core, worldwide taxation is this systemic statutory requirement where citizens absolutely must report their global income. It doesn't matter where you physically live or where that money is generated. It's a highly unique system globally. The implicit assumption here, citizenship itself, not your physical geography, is the primary trigger for your tax liability. Basically, the system assumes you owe everything, and the burden of proof rests entirely on you to navigate these overlapping jurisdictions to prove otherwise. To really understand how rigid this is, look at the concept of accidental Americans. Because citizenship is the trigger, birthright citizenship creates this inescapable lifetime reporting obligation. We're talking about individuals who maybe left the country as infants, have absolutely no functional ties, and no intent to ever return. Doesn't matter. The statutory rule is incredibly strict. You have to report your worldwide income, which forces you to actively use specific mechanisms to offset the resulting double taxation. Which brings us to Section 2, double taxation mitigation mechanisms. We really need to draw a sharp analytical line between the two primary tools here, because this directly impacts your dependent credits later. First up, the Foreign Earned Income Exclusion, or FEIE. Think of this as a base reduction tool. It mathematically removes a specific segment of your income from the tax base entirely. Poof, like those dollars just vanished from reality. On the flip side, we have the Foreign Tax Credit, or FTC. This is a liability offset tool. The income stays in the base, but it offsets your actual tax bill, dollar for dollar, based on what you paid to a foreign jurisdiction. One erases income, the other erases the tax bill itself. To give you the empirical data, the inflation-adjusted income exclusion limit for the 2024 reporting period is locked in at $126,500 per qualifying individual. That is the hard statutory cap on exactly how much income you can mathematically scrub from your base. But expert analysis shows the statutory threshold jumping to $130,000 for the 2025 period. For your long-term modeling, that's a massive actionable insight. It basically dictates whether you're going to shift your strategy from credits to exclusions in the upcoming year, allowing you to project exactly how much of your foreign earnings will be shielded. Now, unlocking this exclusion requires meeting some non-negotiable prerequisites. You need a foreign tax home and foreign earned income. More critically, you have to pass either the bona fide residence test or the notoriously rigorous physical presence test. That second one requires exactly 330 full midnight-to-midnight days in a foreign country within a 12-month consecutive period. Think about that for a second. If your flight gets delayed and you touch domestic soil at 12:01 a.m., bam, that entire day is instantly wiped from your calculation. It is an incredibly high, mathematically exact standard. Let's move to Section 3, income exclusion versus tax credits. The absolute core rule here is mutual exclusivity. Statutory regulations strictly prohibit double dipping. You simply cannot claim a foreign tax credit on the exact same segment of income that you just excluded from your tax base. It forces a proportional reduction. If you exclude the income, you're forced to also exclude the foreign taxes tied to that exact block of money. The cause and effect relationship here is driven by a pretty brutal formula. Step 1, take your excluded earned income minus expenses. Step 2, take your total foreign earned income minus expenses. Step 3, divide the first by the second. And step 4, multiply that percentage by your foreign taxes paid. That resulting number, that's the exact amount of foreign tax permanently stripped of its credit eligibility. The non-obvious pain point here is that leveraging the exclusion will always, inevitably, degrade the mathematical power of your tax credits. And we have to be clear on what actually qualifies for a credit in the first place. The statutory definition demands a compulsory payment. This is a huge, non-obvious detail. A foreign tax levy must be a strict, non-voluntary legal liability where you receive no specific economic benefit in return. The implicit assumption is that if you voluntarily overpay a foreign jurisdiction or get a direct good or service out of it, that payment is completely invalidated from credit eligibility. Let's look at how this plays out with international treaties. Say a foreign country's statutory withholding rate is 20%, but a tax treaty actually limits your legal liability to 15%. Well, that 5% difference, that's an overpayment. It's not compulsory. So that 5% excess is entirely non-creditable. The tax authority isn't going to subsidize a foreign country's administrative errors. The burden is entirely on you to fight the local bureaucracy for that refund before you can even think about claiming the rest as a credit. Okay, Section 4, Child Tax Credit Parameters. This is where all these mechanisms finally intersect for families abroad. Here is where the system gets highly intersectional. A common surface-level assumption is that all dependents trigger the exact same tax incentives. They definitely don't. The primary child tax credit absolutely requires the dependent to have a valid employment-authorized Social Security number. If your dependent doesn't have one, you are entirely locked out of the primary credit, and you get bumped into the other dependent credit, which accepts an ITIN or an ATN. Literally, this single identification parameter fundamentally reshapes your entire financial outcome. For that primary child tax credit, the statutory requirements are non-negotiable. The dependent must be under age 17 at the end of the year, they must be a U.S. citizen, national, or resident, and they cannot have provided over half of their own financial support. If you're living overseas, making sure your child meets that citizenship or residency criteria and actually possesses the correct SSN is the absolute central pillar of your financial strategy as an expat parent. Furthermore, these credits are subject to strict income limitations based on your modified adjusted gross income or MAGI. For individual filers, the exact phase-out threshold starts at $200,000. This is exactly where the mathematical degradation of your child tax credit begins. And remember that cause and effects relationship we talked about earlier? How you choose to use the Foreign Earned Income Exclusion directly impacts your MAGI calculation right here. Now, for married couples filing jointly, that phase-out trajectory starts at $400,000. If you're anywhere near approaching these thresholds, precision modeling of your exclusions versus your credits isn't just a good idea, it becomes absolutely vital to protect your child tax credit. Which brings us to Section 5, Alternative Dependent Credits. If you don't meet those struct rules, the system does provide a structural fallback mechanism called the Other Dependent Credit, or ODC. This is incredibly relevant for expat families whose dependents might not qualify for an SSN, but who do hold a valid individual taxpayer identification number or an adoption taxpayer identification number. The ODC acts as a really vital safety net within this broader framework, ensuring that lacking an SSN doesn't result in a total loss of dependent-based relief. But here is the most critical, actionable insight for both of these credits: the procedural imperative. Whether you're using an SSN for the primary child tax credit or an ITN for the alternative credit, that identification number must be formally issued prior to the tax filing deadline, including any approved extensions. You literally cannot retroactively claim these credits if the IDs weren't secured in time. Timing is an absolute, unforgiving constraint in the system. When you step back and analyze this entire system, the inescapable baseline of worldwide taxation, the mutual exclusivity of your mitigation tools, the rigid ID parameters for your kids, and those strict MAGI phase-outs, you realize these aren't just isolated rules. They are a deeply interconnected mechanism. So how does the exact mathematical intersection of worldwide taxation, exclusion formulas, and dependent credit thresholds fundamentally redefine your financial strategy? It's a massive, complex puzzle, but mapping out the system is the only way to actually solve it. Thank you so much for joining me for this explainer.